Interest rates continue to collapse. The 2-year U.S. Treasury today yielded just 3.61%. How low is that? We've never seen it this far below the Federal Reserve short-term rate targets before. It's a record difference, and it's only getting worse. What that means is pretty simple. The Fed follows the market, and the market is saying the Fed is going to be cutting rates by a lot. When combined with the recent macro data like payrolls, plus the ongoing crash in commodities right now, which are just getting absolutely smoked, it tells us why. It tells us why the Fed is going to be cutting rates by a lot. This isn't just some slowdown, which is just where the narrative is grudgingly shifted. It went from strong and resilient to, well, it's a little weak, but otherwise no big deal. That's not what the real markets are pricing. And pricing is more than just a small possibility. They are altogether saying something big is going on, really going down right now. Oil is down by 20% in less than a month and down almost 5% just today, even though there's a tropical storm in the Gulf of Mexico taking production offline. Gasoline is off almost 20% in just less than 2 weeks. Even the Fed knows the situation is worse than the data currently shows, and the data right now is already getting ugly. And the markets know that the Fed knows that. So officials won't say it in public, but they definitely are talking about it in private. And I'll show you an example of what I mean here. The signals are clear. This isn't a vibe session. This isn't some slowdown. It's the real thing, and everything continues to look more and more like it, even if the stock market doesn't see it yet. Follow the 2-year. Been saying that all along. You don't have the 2-year a record amount below the Federal Reserve's short-term targets if everything is just fine and dandy. But everything just fine and dandy is what the stock market is saying, what people who talk about the stock market are themselves talking about. I'll give an example from Bloomberg just yesterday. U.S. equities are unlikely to slump 20% or more as the risk of a recession remains low against expected interest rate cuts from the Fed, which are absolutely worthless, according to Goldman Sachs Group's strategist. The team led by Christian Mueller-Glissman said that while stocks could decline into year-end, hurt by higher valuations, a mixed growth outlook, and policy uncertainty, the odds of an outright bear market are slim as the economy is also being supported by a healthy private sector. And none of that is what these markets are telling you. From the 2-year Treasury to oil and gasoline, copper and gold, swaps, forward rates, and on and on and on. While stocks look okay and they can say the market's being supported in part by a healthy economy or private economy, that just isn't true. Or if it was true, the markets are saying it is no longer true. Because that's what it really comes down to. The economy has shifted, and it is still shifting. And if you thought it was good before, then it's at least shifting to something worse than good. And if you thought it was weak before, as the actual data has shown, then what does that say about everything else, especially as energy prices are getting absolutely crushed? I'll go over where they are today toward the end of this video. But as I said in the introduction, the 2-year, it's all about the 2-year right here. Even the Federal Reserve knows it's about the 2-year, and I'll talk about that in just a moment. The 2-year as of today, 3.61%, where the 10-year at 366, which is also moving lower. That still means the 2-year 10-year spread is uninverted in the bull steepening case, which is not a good sign in any way. And the federal funds upper bound target rate is 5.5%. RRP, federal funds target, all of it. The Fed is way up in the 5s, middle 5s, and the 2-year is way down in the middle 3s. We're talking about a nearly 200 basis point spread. It's actually 189 basis points to the federal funds upper bound, which is the most on record. Going back to 1982, when the Federal Reserve started targeting the federal funds rate, we've never seen the 2-year this far below the Fed's numbers. And it's down 47 basis points just since August 15th. And I talked about that before. August 15th, everything began to change. And all over the world, even Chinese government bonds, energy markets, commodity prices, JPY, Japan's yen. Everything got crushed late July into early August. Then it came back a little bit. But August 15th, second half of August into the first part of September, summertime is the time for recession. That's what everything continues to show, including and especially the 2-year U.S. Treasury. Now, there are several times throughout the last 40 years where we've seen the two-year go way below the federal funds target, if not quite this far. And in each instance, what that has suggested very strongly, the further it goes below the Fed's target, is that the Fed will start cutting rates. And not just by one rate cut or two. In almost every case, what it's pricing is the beginning of a series of rate cuts. This is something, by the way, that I went over at Eurodollar University's Deep Dive Analysis, a subscription service where we go way beyond everything that we talk about here on YouTube, much deeper into all of these topics, as well as covering an extensive array of topics that we don't get to go over here on YouTube or any other social media platform. That's Eurodollar University's Deep Dive Analysis. Check out our website for details about that subscription. The first time that we saw the two-year go so far below the federal funds target, which before 2008 it was just a single target rate, was the summer of 1989. Before anybody had ever heard of Iraq and Saddam Hussein, there was the S&L crisis in the U.S. banking system, and there was also a Federal Reserve that was experimenting with its interest rate targeting tool for the first time, really, trying to dampen inflation pressures that they saw that weren't actually in the real economy. So the Greenspan Fed had raised the federal funds target, and therefore the federal funds rate, the effective rate, went up with the federal funds target in 1988 and 1989. And by the summer of 1989, the two-year U.S. Treasury yield was going way below the federal funds target, suggesting that the Federal Reserve was about to turn around and pivot, and not just in some small pivot, but over the next couple years, there would be a lot more rate cuts than just one or two. And then, of course, that's exactly what happened. So where the two-year spread had been 150 to 160 basis points below the federal funds target in the summer of 1989, Greenspan immediately cut rates from the summer of 89 through the second half of that year, and then would cut rates again in 1990 as the S&L recession finally did show up. And that's the thing that we keep coming back to. When the two-year Treasury goes this far below the current short-term interest rates, that means that there's going to be, at the very least, rate cuts from the Fed and lower rates in the marketplace, lower growth and inflation expectations, they follow as well. And it's not just one or two. We're talking about many, several, lots of rate cuts because the Fed ends up chasing economic weakness that it can't really do anything about with its interest rate cuts. And they know it too. The next time we see the two-year Treasury so far below short-term interest rates was during the Asian not financial crisis of 1998 in particular. In October 1998, the spread between the two-year and short-term interest rates got to be 100 and a maximum of 120 basis points in October of that year. And the Federal Reserve would cut rates just a couple times, 98 into 1999. So the intensity of the two-year spread and how far it goes below short-term interest rates does give us a sense about how aggressive the Federal Reserve is going to be because of it is a reaction to how the situation is developing in the real economy. Quite different when we move to the next one, which was in late 2000 and the very start of 2001, heading from the dot-com bust in the stock market into the dot-com recession of 2001. In early January 2001, the two-year Treasury was 163 basis points below the federal funds target of that time. And that was January 2nd, 2001. And on the very next day, the Federal Reserve held a conference call, not a scheduled meeting, in which they discussed the situation and decided that the market was right. Here's what Alan Greenspan said during that conference call. In the current situation, then, rates are higher than we actually need, a fact that is reflected in the very sharply declining yield curve from the spot overnight rate out to 2 years. What the markets effectively are saying to us is the funds rate is too high. And I think all of the evidence does suggest that that is correct. But what did that evidence actually show? Why was it correct? Not just that the economy was slowing down, as some on the FOMC and especially in the mainstream media were asserting. They always say it's nothing more than a slowdown. What the markets were saying was that this was a bit more than a slowdown. This was full-on recession risk. Let's go back to the FOMC meeting here. This is from Kathy Minahan, who was part of the FOMC voting members. If we're looking at just the real economic data, we would say that the economy appears to be slowing from a 5.5% to 6% rate of growth to around 2 to 2.5%. But that's not terrible. It's the change in tone and the speed, which it seems to be occurring, that is terrible, and that this move could help, talking about the rate cut. And it was actually Chairman Greenspan who called her out and said, well, wait a minute here. You're saying that the economy is slowing down, that it was 6.5% and it's only going to 2%, which this should sound very familiar. So we went from a red hot economy to one that slowed way down, big deal. And so we'll do a 50 basis point rate cut as a little bit of insurance. But Greenspan said, nah, you're being too hopeful. He said, well, the only problem is that by no means is it obvious the economy is growing at 2.5%. I say that because in a period like this, the data that we deal with, remember, almost always tend to be revised downward. When we look back retrospectively at periods like this, they usually turn out to be worse than initial impressions because a lot of the preliminary estimates involve merely plugging in the numbers of the previous month before the pace of activity went down. And pay attention to this because nothing has changed. So I think we have to be a bit careful about suggesting that there's a host of psychological problems out there that we are going to minister to by changing the federal funds rate. That's the vibe session. He's talking about how many people were believing in 2001, that cycle, that it was just a vibe session. They may well be the case, and I hope it is, but we can scarcely persuade people in the market that they have an unrealistic view of what is happening, and we're going to move rates down and change their view. I don't think that works, and that's exactly what the Fed nowadays says. They downplay the weakness, understanding that it's likely weaker than the actual current economic statistics show, and then hope that somehow, some way, lowering the federal funds rate might persuade people to behave psychologically different, become more optimistic, and therefore act on that optimism. And here's Greenspan in 2001 on the cusp of the dot-com recession saying, yeah, I don't think it works that way. But the important points here, what he said was that the 2-year Treasury was saying interest rates were too high given the current conditions. Not that they were being restrictive. That's not how the market thinks about it, and that's not how the market works. The market was saying that interest rates are too high relative to economic fundamentals. And the Fed interprets that in their own language of funds rate being too restrictive or too accommodative, in that case, too restrictive. So Greenspan was saying we need to follow the 2-year Treasury because conditions have changed. And other FOMC members were saying, yeah, well, conditions have changed, but isn't that from a really good economy to maybe one that has slowed down? And Greenspan, to his credit, as was often the case in private, he said, well, we hope that it's just a slowdown, but given the way the market is reacting, we shouldn't be complacent about it. We should realize that as bad as it looks today, we know that the data is going to be revised and it's going to look a lot worse tomorrow when the new numbers come in. And again, this sounds exactly like what we're going through right now. What the markets are saying when the 2-year goes so far below short-term interest rates is that the feces and the fan blades are and have gotten together. It's already to the point that it's probably too late. From the Fed's perspective, they want to cut rates to try to help out psychology in the economy and the marketplace when the marketplace, the Treasury marketplace, the real marketplace, especially when you add commodity prices, I'll get to in just a second, they are saying that it is already too late. And we saw that again in the next cycle, the Great Not Recession. The 2-year Treasury went well below the federal funds target in August and September of 2007. We're talking about 100 to 120 basis points below the target, a maximum of around 135 to 140 basis points by September 2007 when the Fed started cutting rates with another 50 basis point rate cut. And while that backed off the spread a little bit because the Fed moved the funds rate down, the 2-year Treasury kept going even lower. In fact, it got to the spread between the 2-year Treasury and the federal funds target got to 150, 160 basis points in November and December 2007, despite that rate cut back in September to begin with. And what that meant was, as the 2-year kept going lower and the Federal Reserve kept trying to catch the 2 years, that the market was sensing that conditions were worsening to such a degree that rates would have to continue to go down because the Fed would never be able to get to the bottom of the recession. That it was going to continue to get worse as the first half of 2008 developed. And as everything gets worse, the Fed responds to that weakness by cutting rates and moving rates lower. So there's a fundamental case for the 2-year going down, lower growth and inflation expectations over the near term, as well as that being compounded by policymakers who are reacting to the same thing. There are, and I hesitate to bring this up, but there are similarities here to the summer of 2008. Now, I don't mean a crisis. I don't mean banking and panic and everything else in terms of the real economy. As I keep saying, summertime is the time for recession. Well, summertime is usually the time that the recession that's already begun really begins to show up. That was the case in 2008, and that was the case to a high degree in 2001 as well. The recession started earlier the year 2001, but we really didn't see the bulk of it, the real heavy part of it, until the summer of 2001. Same thing for the Great Not Recession. It began in December of 2007, but it really didn't start to feel like it and show up like it until July, August, and especially September 2008. Now, again, I'm not saying there's going to be a Lehman Brothers or a banking panic, but in terms of general macroeconomy, that's how everything seems to be developing. And one of the ways that we can see that, and one of the reasons we know why the Fed's going to be cutting rates because of economic weakness, is because of what we see in the commodity markets, in particular energy. If you remember back in 2008, if you're old enough to remember back in 2008, it's that long ago, energy prices had soared. They had surged through the first half of the year on supply considerations. It was really a supply shock back then. And then in July of 2008, they just started to plunge, both WTI oil prices as well as gasoline. Now, we haven't seen anything to that extent here this summer, but the proportions are really getting unnerving here. We're talking about WTI that's down to $65.58 today, which is the lowest WTI price since December of 2021. It's down almost 5% on the day, despite the fact that some of the big oil producers are pulling their personnel off of offshore oil platforms because of Tropical Storm Francine. So a supply reduction normally of this kind usually leads to oil prices rising. Instead, they're falling by almost 5% on the day. They've been down 13%. WTI is down 13% since August 29th, and it's down 20% since the middle of August, back on August 12th. That's despite OPEC taking their restoration of supply back off the table, saying we're going to continue to hold the supply cuts until oil prices stabilize. Well, they're not stabilizing. They continue to go to new lows. And like 2008, that's the demand part of the oil market starting to reassert itself as the biggest factor that we all need to pay attention to. That's certainly the case in gasoline. I keep mentioning wholesale gasoline in the US, largely because, first of all, it's a pretty shocking decline. But second of all, it tells you this is not about China or some overseas factor. This is US demand that the market is pointing towards, saying it's going to fall off pretty sharply if it hasn't already over the next couple months. At $1.87 wholesale at the CME, that's the lowest gasoline price since February of 2021. It's down 3.5% today itself, down 17% in just under 2 weeks since August 29th. It's not what was in those quotes that I mentioned at the beginning of this video where they said, oh, the stock market's just fine, the Fed's going to support it with a few rate cuts, or the private economy is relatively healthy. That's not what oil and gasoline are telling us. They're telling us the private economy, if it was healthy, and that's debatable, there's a lot of data that shows it wasn't, but even if it was healthy, it isn't going to be much longer. So energy prices combined with the 2-year treasury, lots of rate cuts, energy telling us why there's going to be lots of rate cuts. The Fed is going to be responding to the weakness that's already priced in to interest rates and interest rate markets. That's what interest rates are telling us. That's what energy prices are telling us. They're telling us all together, this is not just some normal, everyday slowdown from a hot economy, a high growth rate, to a relatively stable and gentle one. This is not soft landing types of indications. And the stronger they get, the more the 2-year treasury goes below the short-term interest rate, the stronger these signals get. Not only does that tell you the more confident the market is in these scenarios, the worse those scenarios are looking to be as we head toward them. Just to show you how globally synchronized this all is, it's not just a US problem. Look at bond rates in China, which we did just yesterday in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.